Hey everyone, welcome to Smart Credit Bytes. I'm Sangeeta Sharma and I'm so excited to be starting this podcast journey with you. This is actually my very first episode and I can't wait to share what I have learned about credit and finance in simple bite-sized pieces that actually will make sense. Today I wanted to start with something that really matters to so many people. Why MSMEs? That's micro, small and medium enterprises struggle so much when it comes to getting credit. I choose this topic because I see it's happening everywhere around us, and I thought, what better way to kick off this podcast than by talking about something that affects millions of small business owners every single day. If you have ever wondered why your neighborhood restaurant or that amazing local shop seems to have such a hard time getting loans, stick around because I am about to break this down for you. And yeah, if you are thinking about starting your own business someday, this episode will definitely give you some insight to think about. So, first thing first, let's talk about what MSME actually are. These are the backbone of most economies around the world. We are talking about your local bakery, the small manufacturing unit down the street, that tech startup your friend launched, or even that home based business your neighbor runs. In simple terms, we can say if a business employs fewer than 250 people and has a turnover below a certain threshold, which varies by country to country, it's actually classified as an MSME. These businesses are absolutely crucial because they create jobs, drive innovation, and keep local economies buzzing. But here's the thing, despite being so important, these businesses face a massive challenge when it's come to accessing credit, and I mean massive, right? Studies show that there's a credit gap of trillions of dollars globally for small businesses. That's money they need but simply can't get their hands on. Now you might be wondering why this is such a big problem. Well, let me share a story with you. Imagine you are running a small business. Maybe you make handmade furniture. Business is good, orders are coming in, but you need to buy more wood and hire an extra worker to meet the demand. Sounds like a good problem to have, right? But wait, you have to walk into a bank, confident and excited. But then reality hurts. The loan officer asks for documents you've never heard of, wants 3 years of audited financial statements, asks for collateral worth twice your loan amount, and want to see a detailed business plan with projection that you are not sure about. This is where the struggle begins, and it's just not one problem. It's like a perfect storm of challenges all hitting you at once. Okay, let's break down these challenges one by one because you are understanding them in the first step to solving the problem. Challenge number one, the documentation nightmare. Most small businesses, especially the really small ones, don't maintain formal financial records. I'm right, right? They might have a notebook where they jot down sales, or maybe they have a simple app on their phone. But banks are formal, audited financial statements they require, right? They want tax returns, profit and loss statements, balance sheet, basically a paper trail that many small businesses simply don't have. And here's a catch. Without proper documentation, you can't get credit. But maintaining proper documentation costs money and time that small businesses often don't have. It's like being told you need a car to go get to work, but you need a job to afford the car. Now, this challenge number two, the collaterals. Banks are naturally risk averse. They want to make sure that they will get their money back. So they ask for collateral, something valuable they can take if you can't repay the loan. For small businesses, this usually means putting up your home, your shop, or your equipment, or your FDs, or your policies as security. But think about it. If you are a small business just starting out, you probably don't have assets worth hundreds of thousands of dollars lying around. And even if you have some asset, Risking your home for a business is a scary proposition for most of the people. So now let's go with the challenge number 3, the credit history puzzle. Here's something that might surprise you. Businesses need credit history just like people do. But how do you build business credit history if no one will give you credit in the first place? It's another one of the circular problems. Bank looks at your business credit score, your payment history with suppliers, your track record with previous loan, but if you are new or you have been running on the cash, you don't have this history. It's like being a fresh graduate looking for a job that requires 5 years of experience. Now let's go to challenge number 4. One size fits all problem. Traditional banks have standardized process. They use the same criteria to evaluate a tech startup and a grocery store, a manufacturing unit and a consulting firm. But the reality is different. Businesses have completely different cash flows patterns, risk profiles, and funding needs. A seasonal business like an ice cream shop will have very different financial patterns compared to a software development company. But banks don't have the flexibility or expertise to understand these nuances. Now, where it gets really interesting, it's not that banks don't want to lend to small businesses. In fact, the MSME sector represents a huge market opportunity. The problem is that the traditional banking system was designed larger, more established companies with predictable cash flows and substantial assets. Think about it from the bank's perspective for a moment. Processing a loan application costs roughly the same whether it's 10,000 or 1 crore. But the profit margins are very different. So naturally banks tend to focus on larger loans to bigger companies where they can make more money with the same amount of effort. This creates what economists call a market failure. There's demand for credit for small businesses and there's money available to lend, but the two sides can't connect efficiently. But wait, it's not all doom and gloom. The landscape is changing and there are some really exciting developments happening. First, technology is revolutionizing how we access creditworthiness instead of just looking at traditional financial statements. New age lenders are using data with your digital payment history, your social media presence, even your mobile phone uses pattern to understand your business better. For example, let's take an example. If you are a small retailer who processes payments through digital platform lenders can analyze your transaction data to understand your sales patterns, seasonal variation, and growth trends. This gives them a much clearer picture of your business than a static financial statement ever could. Second, alternative lending platforms are popping up everywhere. These are companies that specialize in small business lending and have designed their process specifically for MSMEs. They understand the challenges we talked about and have created solutions around them. Third, governments around the world are recognizing their problem and stepping in with guarantee schemes, subsidizing lending programs, and simplified processes for small business loans. So, what this all mean if you are listening to this, whether you are running a business now or thinking about to start one, how eh, how about I tell you some practical things I want you to take away from this my first very episode. First, start building your financial discipline early. Very important. Even if it's just a simple spreadsheet, maintain records of your income and expenses. It doesn't have to be perfect, but having some documentation is indefinitely better than having none. Second, explore alternative funding sources. Just don't think about traditional banks. Look into fintech lenders, peer-to-peer platforms, government schemes, or even crowdfunding depends on the business type. Third, build your relationship before you need them. Connect with your bank even if it's just for a saving account. Get to know local business advisors. Join small business network when you do not need credit. These relationships can make a huge difference. And finally, remember that being rejected for credit doesn't mean your business idea is bad. It often just means you haven't found the right lender or the right time yet. The world of MSME is complex, but it's also evolving rapidly. New solutions are emerging every day, and there's growing recognition that small businesses are the engine of economic growth. If you are struggling with credit access, know that you are not alone. And it's not necessarily about the quality of your business. Sometimes it's about finding the right fit between your needs and what's available in the market. That's a wrap on today's episode of Smart Credit Bytes. I hope this helped you understand why credit access is such a challenge for small businesses and what's being done about it. If you find this useful, please share it with someone who might benefit. And if you have questions or topics you would like us to cover, just drop a message. Until next time, keep those credit bytes smart. Thank you.